Grab your spreadsheets and put on your professional equity analyst hats, folks, because today we're diving into a real financial mystery. We've just received a massive data dump on a company called Axos Financial, and our job for this explainer is to figure out its true intrinsic value. So are we looking at the bargain of a lifetime here, or just a mathematical illusion? Well, we're going to rigorously value this stock using every single tool we have in the Analyst toolkit to find out.
Okay, let's dive right into this. Here is our roadmap to demystify these complex models step by step. We'll start with the mystery itself, calculate the absolute valuation, check relative metrics against peers, strip the company right down to its bare assets, and finally synthesize the whole shebang into one final verdict.
Part 1. Valuing Axos Financial, the mystery behind the metrics. Look, every great valuation has to start by understanding the central conflict. We've been handed this incredibly comprehensive dashboard filled with historical metrics, growth rates, margins for Axos Financial, but to really ground ourselves, we have to start with the absolute baseline, $87.41. According to the source data, this was the last closing stock price. Basically, this is exactly what the market is currently asking you to pay for one single share of this business. As analysts, our entire goal today is to figure out if this specific price tag is fair, way too high, or maybe a steal.
And honestly, here's where the mystery really begins. Our source dashboard highlights that current price of $87.41. Sure, but directly alongside it, it prints a fair value price of $323.57. I mean, it explicitly claims there is a staggering 72.99% margin of safety on this stock. If that's true, Axos is massively, incredibly undervalued. But is this reality? Or is this just a mathematical mirage caused by a wonky formula? Let's dig in and find out.
Section 2. Absolute valuation models, or as I like to think of it, calculating the yield of the farm.
You can think of absolute valuation kind of like trying to figure out how much cash a specific farm can produce entirely on its own, completely ignoring whatever the neighboring farms are selling for. And the gold standard here is the discounted cash flow, or DCF model. Step 1 is identifying the actual, tangible cash generated. The source data shows Axos produced $421.39 million in trailing 12-month free cash flow. In a DCF, we project how that cash flow is going to grow over the next 5 to 10 years, and then we mathematically discount those future hypothetical dollars back to what they're worth today using an appropriate cost of capital.
Now, what's really interesting about this is our source data solves our central mystery pretty much immediately by running two totally different DCF models. When they projected the free cash flow, the actual tangible cash, the fair value came out to $79.29. That implies the stock is actually slightly overvalued right now. But when they projected earnings per share, which is an accounting metric, the fair value skyrocketed to that wild $323.57 number. This massive divergence tells us something absolutely crucial. Axos' accounting earnings are growing at a much, much faster rate than its actual unencumbered cash.
So what about other absolute models, like say the dividend discount model? If you're a dividend investor, you value a stock based on the hard cash it pays directly to your pocket. But a super quick glance at our source data solves this one instantly. Axos has a 0% dividend compound annual growth rate. They literally don't pay a dividend, so effectively the DDM value for Axos is just zero. This is a stark real-world lesson for us as analysts. You absolutely cannot use an income valuation model on a purely growth-focused entity. Let's try one more absolute model though, the residual income model. This model takes the company's book value and then adds any extra value created by the company's returns. If we take the current price and divide it by the 1.69 price-to-book ratio from our source, we imply a book value of about $51.72 per share. Now, the source also tells us Axos generates a very healthy 15.58% return on equity. Since this easily clears a sensible assumed 10% cost of equity hurdle, the residual income model justifies exactly why the stock trades at a premium to its book value. They were genuinely creating real value.
All right, Section 3, relative valuation models, checking the neighboring farms.
Now we're going to shift gears. Instead of looking at Axos in a vacuum, we want to look over the fence to see what similar assets are selling for. Our source document doesn't actually list pure data, so as analysts, we have to step up and apply reasonable industry baselines. If we look at standard regional banks, they typically trade at a price-to-earnings ratio of around 10 to 12. Axos sits right in that sweet spot with a trailing PE of 10.84 and a forward PE of 9.55. So based on earnings, it's priced perfectly fair. However, their price-to-book ratio of 1.69 is a little bit elevated compared to a traditional bank peer average, which usually sits around 1.2 to 1.5.
So, you might be wondering, why on earth would the market pay that slightly elevated price-to-book premium for Axos? Well, the source data hands us the answer right in the historical performance metrics. Axos boasts a 10-year return of 340.58%. Think about that. That's a compound annual growth rate of over 16% for an entire decade. When a company demonstrates that kind of relentless, consistent outperformance, the market naturally, and rightfully, commands a slight premium relative to its average peers.
Moving right along to Section 4, Asset-Based Valuation, Pricing the Tractors in Dirt. For this part, we are going to ignore the business operations completely. We aren't projecting cash, we aren't looking at peers, we are simply pricing the literal tractors and dirt. What are the net assets actually worth today? We call this the net asset value, or NAV approach. Now, ideally, we'd adjust every single loan on the balance sheet to fair market value. The challenge? Our source dashboard doesn't provide those granular mark-to-market line items. So what does a pro analyst do? We find a proxy. We mathematically reverse engineered the book value per share by taking that $87.41 stock price and dividing it by the provided 1.69 price-to-book ratio.
And boom, that calculation brings us right back to this vital number, $51.72. By utilizing the book value as our conservative proxy for net asset value, we establish the absolute floor for this stock. If Axos just stopped operating tomorrow, turned off the lights, and liquidated, this roughly represents the net tangible value remaining for shareholders.
Section 5. Synthesizing Intrinsic Value, the Final Verdict. Let's pull this all together.
Okay, we have all our individual puzzle pieces on the table. Now it's time to assemble them into one cohesive investment thesis. Our free cash flow DCF gives us $79.29. We're assigning this a high reliability weight because at the end of the day, cash is reality. Our asset-based proxy gives us a firm $51.72 floor. Our relative valuation suggests the stock is fairly valued right around its current $85 to $90 range. And finally, we have that wildly optimistic $323.57 EPS model. Given that accounting earnings can diverge massively from actual cash in the banking sector, we're definitely slapping a low reliability weight on that extreme outlier.
So, the reality of Axos Financial is that the true intrinsic value sits somewhere between the baseline asset value of $51.72 and the realistic cash flow value of $79.29. The current market price of $87.41 is hovering just above that upper bound. Based on our rigorous analysis today, Axos is an absolutely fundamentally strong performer, but it's currently trading slightly above its synthesized intrinsic cash value. Honestly, it's priced for perfection.
So the absolutely crucial takeaway here is this. When a dashboard screams at you that a stock has a 72.5% margin of safety, you have to stop and ask yourself, is that real? Or is it simply the result of an overly optimistic earnings projection papering over the reality of actual, tangible cash flows? As analysts, we always follow the cash. Thanks for joining me on this valuation journey, and keep digging deeper.